2026 housing market under a microscope to figure out exactly why it feels like everything is freezing up. If you've been tracking the trends lately, you know the market is in this uniquely stuck position. So we're going to dig into the latest data to find out why demand is softening right in front of our eyes.
All right, let's just cut right to the chase with a pretty glaring number. A sharp 5.4% month-over-month drop in pending home sales from June. This single data point really sets up our central mystery for today. Why are prospective buyers suddenly stepping back from the table?
To answer that, we're going to peel back the layers of this market. We'll look at the cooling housing market, that tricky mortgage rate tripwire, how record prices are absolutely crushing affordability, the wild accidental landlord phenomenon, some intense global pressures and Fed policy, and finally, where on earth do we go from here?
Okay, part 1, the cooling housing market, unpacking the pending sales drop.
When we look at the immediate reality across the country right now, it's pretty wild. Month over month, we're seeing a 3% drop in the Northeast, nearly 9% in the Midwest, and over 4% in both the South and West. This isn't just some local weather anomaly or a regional blip, right? This is a total, widespread national freeze.
Dr. Lawrence Yun, the chief economist for the National Association of Realtors, really hits the nail on the head here. He points out that we've got the highest mortgage rates we've seen in nearly a year, just slamming right into record-high national median home prices. It's a brutal 1-2 punch that is making it, well, especially tough for first-time home buyers to get a foot in the door.
Which leads us perfectly into part 2, the mortgage rate tripwire, a psychological hurdle.
Over the last few years, housing demand just seems to hit a brick wall whenever mortgage rates cross the 6.64% line. That specific number? That's our primary villain today. The second rates drift above that level, the market psychology shifts almost instantly.
And we literally just saw this play out in late July. Rates drifted up, spending most of the week above that 6.64% tripwire, hovering near 6.77%. The moment they crossed it, bam! Early demand signals immediately softened. Pending sales went essentially flat year over year, and purchase applications actually printed a super rare negative annual reading. Buyers are just incredibly rate sensitive right now.
Moving on to part 3, record prices crush affordability, squeezing the buyer.
Because even if a buyer decides to just bite the bullet and take that 6.77% rate, they run smack into our second major hurdle, the sheer cost of the houses themselves. Sure, we had a tiny recent dip, bringing the median list price to $449,900, but the broader Case-Shiller index for May saw national home prices actually rise 1.1%. That long-term price appreciation is stubbornly sticking around, sustaining these record-high costs and completely squeezing first-time buyers out of the equation.
And what we have right now is honestly a tale of two entirely different markets. On one side, the existing home market is completely stagnant. Rate-locked sellers are keeping supply super restricted. But on the flip side, the new home market is a completely different ballgame. Builders have a steady 9.3-month supply of inventory, and they are aggressively fighting this affordability crisis. Literally, 62% of builders are offering buyer incentives right now, and they've actually managed to shift 23% of their sales to homes priced under $300,000.
So why is the existing market so stuck? That brings us to part 4, the accidental landlord phenomenon, constricting supply. It all boils down to this fascinating dynamic called the accidental landlord. Basically, this is a homeowner who has to move, maybe for a job change, military orders, or a growing family, but instead of selling their old house, they just rent it out. Why? Because over half of current homeowners are sitting on a mortgage rate of 4% or lower. Giving up that kind of historic, ultra-low rate is just too financially painful. And the scale of this is absolutely staggering. More than 1 million. That's how many existing home sales have essentially vanished in recent years because of this massive gap between current and old mortgage rates. Over 1 million homes that should be up for sale are being rented out instead, which is keeping resale inventory incredibly tight and keeping prices propped way up.
All right, let's zoom out a bit for part 5, global pressures and Fed policy, the macro storm.
To understand what's propping those mortgage rates up in the first place, we really have to look at the broader macro storm brewing behind the scenes. Behind closed doors at the Federal Reserve, there's actually a serious debate happening right now about whether rates might need to go up, not down. And this is all happening as a perfect storm of global, geopolitical, and economic pressures rolls right in over the housing market.
So what exactly is in this storm? Well, it's a pretty volatile mix. We've got the Iran conflict kicking up risks for oil prices, Japan having to step in to support its currency, and right here at home, wage growth actually came in stronger than expected, meaning the economy definitely still has some heat. Combine all that with ongoing hawkish rhetoric from the Fed, and you've got the exact headwinds keeping upward pressure on mortgage rates and freezing our prospective buyers out.
Which brings us to our final section, Part 6. Where do we go now? The standoff. Taking all this into account, I think Mike Meidler, the president and CEO of Century 21, sums up this standoff perfectly. He points out that a buyer sitting on the sidelines holding out for a better rate is betting against a market where homes simply aren't piling up to greet them. Because those accidental landlords have totally stalled resale inventory growth after 4 straight years of increases. Buyers waiting for the perfect rate might find themselves with 0 houses left to actually buy once rates do fall.
And that leaves us with one really big question for you to ponder as we wrap up this explainer. Are buyers on the sidelines making a fundamentally risky bet? Think about it. If rates do finally drop and a massive flood of sideline buyers rush in all at once, is this ongoing supply shortage going to trigger just an absolutely unprecedented explosion in home prices? It is a fascinating standoff for sure, and definitely one we'll be keeping a very close eye on.